Welcome back to today's edition of the Lance Roberts Show podcast at realinvestmentadvice.com. Our special guest today, Charles Nenner from the Charles Nenner Research Center. We're talking about cycles and markets. Just for the break, Charles, we were talking a little bit about, the cycle of what's happened here recently. Wall Street forgets a lot that, cycles do apply to markets. They do regularly occur in markets, just as we have seasons every year. The markets go through cycles, and you can't have one cycle without a corresponding cycle down the road. It's just, and Wall Street tends to forget that. We get into a bull market cycle, and they start extrapolating that the bull market cycle is never going to end. But for every bull market, you do have to have a bear market. And that's what cycle research tells you, right?
Yes, but just, the situation with the banks and brokerage firms, that how they attend to their clients is that they're afraid to sell. And then if it goes down, it says, oh, it's too late to sell now. And then when it's lower, then they start talking about buying opportunities. So when the market comes down and I watch the media, I never see anybody say sell. It's a buying opportunity, because that's how Wall Street works. It's always a buying opportunity. And I just don't think it's fair to the investing public. So the research that brokerage firm and banks give is a bit tainted. It's not like I work, because I don't care if the market goes up and down. The only thing I have to do is have to be right about the direction.
Right.
I don't have fun. I don't sell anything. But the media and the institutions are biased, because they make money if the market goes up and people buy.
Right. Well, they have product to sell, and and if the market's going down, I'm saying, hey, you need to get out of the market. The market's going down. Well, I'm not making any money because I don't have anything to sell you. So to your point, the Wall Street media, et cetera, are all benefit by a bull market and rising prices because they sell product. And for investors, it works out great as long as markets are rising, just not so much when markets are falling. So we were talking about these cycles, and it's interesting because you made a point about cycles is that the markets will tell you that something is going to occur, and then it's almost, it's prescient to the fact that then a few days later, or a few weeks later, a few months later, then something will happen that will cause that cycle to reverse. And it was interesting because, here's a chart of the S&P 500 behind me, and just last week we were writing that in our newsletter that we were due for a correction in the markets. The markets got very extended. The current cycle had been fully processed since January, and we were due for a correction. And the next week, we get back into a trade war, which was completely unexpected because everybody expected a trade war to get the trade war to be resolved, between Trump and China. So it's always interesting to me is how markets predict what comes along or what will come, and then it's almost the environment fits into the schema of the actual cycle itself.
Yeah, but once you understand, then you can invest without making major mistakes. But it's against the philosophy of this world. So it's very hard for people to grasp this problem.
I absolutely agree. And because, it seems too complicated. I think is the big thing. Not enough people spend enough time understanding money to start with. Financial education is one of the biggest problems that we have in this country right now. And I think that when people look at something, you start talking about cycles and Fibonacci levels, MACD lines, etc. It gets so confusing, it gets so overwhelming. They're like, I just don't understand it. But this
it's much more than this, and I don't want to get in trouble. But I never saw people who talk about the climate problem looking at long-term cycles. So. You understand? So The question is are we on the top of a cycle that brings up the temperature and soon we're going to turn around or not? So nobody has any clue where we are. So it's not only about finance. I do it also for fashion. I work with big companies in Hong Kong who have to know what's the fashion in 2 years. So I look at the fashion of the last 60 years, single-breasted, double-breasted suits, whatever, which colors women are going to wear. And that's what we do. We work with the companies who have to bring out CDs. Does it have to be a male singer? Does it have to be a women's singer? Does it have to be in springtime, in December? It all is based on the pattern continues, but the problem is then we have less free choice than we want to have, and people cannot accept that.
So when are bell bottoms coming back in? I guess that's the real question.
Oh, I don't know, but keep them in your closet. It always comes back.
about every 20 years, isn't it? Going back to the market cycle where we are, we are going through this correctional process right now, and you're saying that basically this little sell-off that we're in right now will probably end, have a little bit of rally, I guess, going into the summer months. But are we closer to the end of this cycle? And you alluded to this earlier. And if we are closer to the end of the cycle, later this year, going into 2020 because of a rise of deflationary pressures, what's making you see that now, and what do you think will ultimately cause that?
Well, we have a target of 3,050, 3,060 in S&P. So we have another, from the last high, another 60, 70 points to go. It's not that much.
Yep.
The problem that I see is that usually bear markets and recessions start from a GDP that used to be 5%, 6%, and inflation used to be 3%, 4%. And now we have maybe 2% GDP and a very low inflation. So you can imagine if the economy turns down, it's going to be below zero. And I think it's going to be much worse than most people expect.
Well, and again, we were talking about this the other day. There's a lot of things that actually, portend to that actual position. We have a massive amount of corporate debt, record debt levels really pretty much across the board that are, provide the fuel for a bigger downturn. But I think the point you made is excellent. And I've talked about this a lot. And, when you listen to a lot of the media, they say, well, by the time the yield curve inverts, there's generally 20 months or, however long it is until the recession actually starts. So nothing to worry about between now and then. But to your point, historically, when the yield curve is inverted, GDP is running at 4.5% to 5%, not 2.5%. And so your time to recession is much shorter, just simply because you don't have as much runway to go from 5.5%, 5% to zero. 2.5% to zero is half the time frame, right?
And there's another big problem. The last time there was relatively such a deficit was under Roosevelt, and because of the inflation in the 40s until the 50s, they only paid back like 10 cents on the dollar. But here, if we have no inflation, the Americans cannot get out of this debt situation. So it's going to be a huge problem. There are a lot of problems, but again, if the longer cycle goes down, then everybody says, how about this problem, that problem? We know about the problems, but nobody takes it seriously until the cycle tops, and then everybody comes up with why the market could go down, and it really goes down.
Well, so when you're looking at some bigger macro issues here about debt cycles and those type of things, so I guess this really brings up the question. We went through a big financial crisis in 2008, and it's interesting because I was listening to one of the Fed speakers the other day, and she was making a comment about the crisis, and she goes, the recent crisis, that was a decade ago. But, the scars from that crisis are still very real for many, many people. Do you think the next downturn in bear market / recession in the economy is going to be as bad as that, or will it not be as bad?
It will be worse. There is something that I call the super cycle that started like in the 1817, 1880, the first Berlin crisis, and the 1929 crisis. And then we had the Fed, and the Fed decides we're not going to have a big recession, not a depression. We have all kinds of tricks. We take out the money supply, then companies will get issuing stock, and then they decided in the 80s to issue only bonds. And we keep it going until we run out of ammunition. And now we're out of ammunition. So it's going to be much worse than in 2007, 2008, because there is no way of fixing it anymore. One time you have to let the whole thing collapse before you can start all over again.
That's a great point. Charles Nenner Research Center. We're going to come back, finish up our conversation with Charles Nenner right after this break. You're listening to Lance Roberts Show podcast right here at realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.